If you are a self-investor, which basically means you prefer to use your own money for your own investments, whether you're a business owner reinvesting cash flow back into the business, maybe you're flipping homes, maybe you're into the stock market, whatever your kind of go-to is as your means of earning, you prefer to be in control of your own money. You don't want to give your money to someone else to make your investment decisions for you. But you recognize that you need life insurance and a fairly large amount of life insurance. Maybe you have a very valuable business. You need to insure the shares, insure your ownership, and there may be taxes that are going to be owed when you pass away. Maybe you have a bunch of rental properties and they all have capital gains. So there's going to be capital gains taxes that are going to be owed when you pass away and give these properties down to your kids. Maybe you need key man insurance. Maybe you have a family cottage that you bought 20 years ago for a lot less than it's worth today. Whatever the reason is, you recognize that you need a large amount of life insurance. So here's the dilemma. You recognize you need a large amount of life insurance, you want to get the life insurance, but you don't want to be out of pocket large premiums to pay for this life insurance. So the question is there anything that can be done that allows you to get the life insurance you need, but at the same time having your own money to make your own investments? And the answer is yes, of course. Now, in a strategy like this, we're going to be talking about a tax-exempt whole life insurance policy. And these policies are special in nature, where they come with more than just a death benefit. So yes, buying this type of policy will provide the death benefit you need to deal with, all the reasons I've already listed. But for you to get your money back and help keep your own money in your own pocket, these policies come with an investment called the cash value. So every single year, as you're putting money into these policies, you have the cash value in your own policy growing on a very tax efficient basis. You're not paying tax on the growth year over year. It's actually guaranteed to increase. It's guaranteed not to decrease. And it's a very safe and liquid type of investment. So how does this help you get your money back? Well, what we're going to do is you are going to put the policy in force, which means writing the check for the first year premium. Let's take an example of someone who needs $2 million of permanent life insurance and the premiums are $100,000 per year. So they want the 2 million, but they don't want to be out of pocket the 100,000. So what they would do is write a check for the $100,000, put the policy in force. But what they're going to do as soon as they put the policy in force is borrow back against their own cash value. And they're going to borrow back anywhere from 50% all the way up to 100% of their premium. So what that means is they're borrowing anywhere from $50,000 to $100,000 back per year, so they can take that money, make their own investments, and they still have the life insurance in force. Now, with a strategy like this, yes, there is interest charged. Now, the interest can be paid out of pocket, or it can even be capitalized, meaning the interest is being owed, but it is being added to the balance outstanding. It is not being actually paid out of pocket, so it is a cash flow neutral strategy. For someone who might need a bit more insurance, maybe they need 5 million and the premiums are 250,000, it's going to be the same thing. As long as you can write that first year premium, you're going to be able to borrow back anywhere from 50 to 100%. And if someone needed somewhere along the lines of 10 million or $20 million of insurance and the premiums were $1 million per year, you guessed it, it's the same thing. As long as they write that first year premium, they're going to be borrowing back 50 to 100% of that premium. Now, in a strategy like this, there are many things to consider. You'll have to go through financial underwriting. You need to consider perhaps putting up additional collateral to borrow the full 100% back. You need to think of interest rates. You need to think of a lot of financial risks that can be associated with a strategy like this. Now, this is a very high-level explanation of a strategy like this, but it is a very accurate explanation of how this would work. You would pay for and fund a tax-exempt whole life insurance policy, and as soon as you write that first year premium, you would borrow back anywhere from 50 to 100% of the premium, take that money and continue to make your own investments. And you would do this every single year. So every single year, you're writing a check for that annual premium, and then you're borrowing back against your own cash value anywhere from 50 to 100%. Now, why do some people choose to only borrow 50% back? Some choose to borrow 80% back, and some choose to borrow all of it back. That really comes down to your own preference, how much underwriting you want to go through, if you want to put up additional collateral, and a few other factors to consider. Some people want all the money back and they're confident that they're going to make more with whatever they're doing with it. Some don't need it all back. They just want a portion of it back. So borrowing 50% is fine. They can be out of pocket a little bit and they have some of their money back. It's flexible to your own individual scenario. So to summarize, this is a strategy that allows a self-investor or someone who wants to get their money back the ability to buy the large amount of insurance they need, but at the same time getting their money back so they can make their own investments, and they would either pay interest on the line of credit they're getting, or they could capitalize the interest depending on the lender. And of course, the other financial risks I talked about in this video are to be considered in a strategy like this, but nonetheless, it is a way that is friendly for cash flow and still allows you to get the large amount of life insurance you need. Thanks for watching.